Hi, everybody. I am Matt Dickin, founder and CEO of Strategic Wealth Designers, and thank you once again for tuning in to our next edition of Strategic Wealth Live, where I'm going to be discussing how to know and understand how much you're paying in fees and expenses within your accounts, and we'll maybe talk about some ways to possibly reduce the amount of fees and expenses that you're paying, as well as I'm going to be giving a bit of an economic update to talk about some of the things that we've seen happen since the last time that we were together. As usual, we still have individuals logging in. We're going to show you a brief video clip of some of our most recent news appearances that we've done as a firm. And then as soon as the video is over, I'm going to jump into the presentation and should make sure that our talk here today is no more than maybe 30 minutes or so. So enjoy the video, and I will be right back with you in just a moment.
It seems like they're always slower to move. You know, you always hear about oil prices getting slashed, but then when you look at the gas station, nothing changes. But if oil goes up by a few dollars a barrel or a lot, then you know, we see our prices at the pump change almost immediately. So I don't know if $1 is in our future anytime soon, but I don't necessarily think it's a good thing either.
Right now you're in the situation where you don't have a job. You should be rationing that out, trying to make sure that you're able to continue with paying your bills. Now, let's say, for an example, you still have your job and you've gotten a stimulus check. It's going to be very tempting to go out and spend that on something really exciting. I would not do that because you don't know how much longer this thing is going to last for.
Under the Secure Act, what they've done is, because of so many hardships in America right now, they're allowing, as long as your mortgage is federally backed, they're allowing you to take advantage of forbearance for up to 180 days. Now, if you get to that 180th day and you're still under financial troubles, in certain circumstances, they'll allow you to go another 180 days to either reduce or completely stop paying your payments for that time.
Okay, thank you for tuning in and watching that video. Like I mentioned a few moments ago, we're going to be discussing fees and expenses within your accounts and how to find out exactly what you're paying in fees, as well as ways to potentially reduce them. Before I get into that, I do have some things that I want to share with you as far as a economic update. So let's jump right into that. Since we last talked, few things have obviously happened. We've got the payroll protection program, which had its original funding basically run out. They've added additional funds to that now. So an extra $321 billion available for small businesses. Those that are under 500 employees are eligible to apply for that. That brings the total relief package that we've passed within the last month or so up to about $3.7 trillion that we are now going to be responsible to pay back at some point in the future. That brings the U.S. debt to GDP ratio up to 110%, which is basically the highest that we've seen since World War II. Unemployment is projected to be over 20% at this point. We've seen, you know, over 20 million now, closing in 30 million individuals have applied for unemployment, as well as additional companies like Disney and others have mentioned that they're going to furlough, and additional layoffs are to come in the future. Those were some of the main things that I wanted to cover with you briefly before we get into the real topic for today. But I had a few other notes that I wrote down as well that I wanted to share with you. But before we move on to that, if you have questions as I'm going through the presentation here today, you know, submit those questions to us. We may have an opportunity to answer them through the presentation, but if we don't, then someone will definitely get back to you with a response. And then also let us know where everybody's tuning in from. We have offices in Louisville, Lexington, Indianapolis, Cincinnati, as well as Denver. And we have a lot of friends and family members of our clients that have been tuning into the webinar. So we're always curious to see where everybody's tuning in from. So let us know that as well. But today here personally in the office is kind of a special day for me because today is my birthday. My staff was nice enough to remember that it's my birthday. They gave me a great card and has a little song. If you can hear the song there. that they added. So that's obviously a blast from the past. So I just wanted to say thank you to all of our staff for remembering my birthday. You know, here at Strategic Wealth Designers, we give our staff their birthday off so they don't have to come into the office and work. And usually I would be taking today off, but considering the times, I definitely wanted to come in and make sure that I didn't miss an opportunity to see everybody and meet with everybody today during the presentation. So thank you to everybody for all the great happy birthday wishes, and seeing some individuals sharing where they're from. We've got one individual from Florida, Margaret, so that's great. Tracy up in Indianapolis. Looks like we've got Bonnie from Cincinnati, Susan from Lexington. So yes, once again, we've got individuals from all over the country that are tuning in. So thank you for taking some time out of your day to hear what we have to say and share with everybody. Some additional notes that I wrote down that I wanted to make sure that I covered is earlier we saw that the Federal Reserve has decided to leave interest rates right where they are, so no movement there, and that was kind of expected. So no movements there. However, you really need to watch out for having money invested right now in bonds and in bond funds. If you've tuned in to previous webinars in the past, you've heard me talk about some of the issues there, as well as I'm going to touch on them again here today. There's an old adage or an old saying within the investment world or investment industry that equities will follow credit. And whenever we do these webinars, we try and keep things as high level as we can, give you information that you need to know, but we try not to get too technical. But the main thing that you need to understand when we're talking about interest rates right now is the bond markets are acting as if they kind of know something that the stock market doesn't know. They usually kind of run in somewhat of coordination, and right now they're out of alignment. And that's very concerning to individuals that have money invested in bonds. And basically what's happening is the bond markets right now are indicating that the stock market may give back the majority of the gains that it's seen over the last several weeks. So again, I'm going to touch on that here in more detail in just a few moments. And then we've seen since we were last together, many companies announcing that they are absolutely slashing or eliminating completely their dividend programs. And Harley-Davidson was the one that was in the news here recently. They've decided to reduce their dividends 95% from what they were. So they're just going to basically leave a little bit of a token dividend left. So those that are looking to invest in dividend income paying positions and companies, that's going to be very difficult to do in this environment, and probably something that's going to be difficult for the foreseeable future. So we're going to be covering in future webinars some alternatives to dividend paying positions, but it's obviously another sector of the economy that we need to be paying close attention to. And then I also have some notes that I'm going to share with you at the end of today's webinar. So you want to make sure that you stay tuned, where I'm going to be talking about some of the top 10 tips or just kind of ideas that some of the best economists in the world, frankly, are talking about and have shared recently. I'm part of a nationwide study group, and so we have access to different economists, and I've been on several different conference calls where we're able to ask questions and get further clarity and information, and that helps us as a firm make investment decisions as well as educate our clients. And there were some interesting comments that have been made recently that I want to wait until we're done with today's presentation and go into a little bit of detail with you at the end. So like I said, definitely stay tuned for that. Okay, let's jump into the main part of the presentation. And again, if you have any questions, please submit those as we're going through. We may answer them. But again, if we don't get a chance to answer them here today, then someone will reach out to you. Nancy says that she loves the new shirt. Thank you. My wife will love to hear that because she bought it for me. So thank you for the comment there, Nancy. And I'm seeing a ton of happy birthday messages as well. Thank you to everybody that's submitting those. Really do appreciate it. But again, what we're mainly talking about here today is how to find out and know how much you're paying in fees. And then if you're paying what we refer to as excessive fees, what you can do about it. So what we have here on the screen is a list of fees and expenses. And there's others we could have added, but we didn't want to belabor the point. These are some of the most common fees and expenses that we'll see that individuals are paying. And what's interesting is a lot of times we'll ask the question, hey, what do you think you're paying per year in fees and expenses expressed as a percentage? And so I'm going to ask everybody that question here today. If you don't mind, you can submit what you think the answer is. Again, we won't necessarily share anybody's intimate details, but if you want to just take a guess, what the typical response is when we ask that question, how much are you paying in fees and expenses on your portfolio? Submit those, and then I'll come back to that in just a second. But here we have a list of common fees that individuals are paying. So just explain each of them briefly. You have 12B1 fees, which are typically charged by mutual funds. That's a fee that they charge so they can actually go out and market their services to other people. So if you have money invested in mutual funds, typically you're paying this fee, and you're actually paying the mutual fund company to go out and advertise to generate additional fees and expenses and assets for themselves. So that's a fee that we typically recommend individuals avoid. Again, if you have a mutual fund, you're going to have a management fee. So that's what the mutual fund charges for doing the day-to-day management on the account. And we're going to show an example of that here in just a second. You sometimes have what's referred to as a wrap fee, or said another way, that's an advisory fee. So that's the fee that the advisor is charging to manage the account. And that's usually maybe 1% to 2% per year is fairly common for that particular fee. And we'll meet with individuals a lot of times, and they will think, if they're paying a wrap fee of 1% to 2%, they'll think that that's the only fee that they're paying within their portfolio. But that, unfortunately, is not necessarily the case, especially when we see money invested in mutual funds. And when that happens, we kind of refer to that scenario as what's called a double dip account. You're kind of paying twice the fees. If your advisor is charging you a wrap fee or an advisory fee, and then he or she is investing the money in mutual funds, you have to pay the fees on the mutual funds, and that's where you get into the double dip scenario, which is something that you definitely always want to avoid. And again, I've got an example that we're going to go over with you on that in just a moment. Mortality and expense fees are another cost sometimes associated with variable annuities. Turnover percentage, I'm going to touch on that again in just a moment. That generates trading costs. Then you sometimes have account fees. And account fees or annual fees are sometimes pretty nominal. This is where you'll see individuals paying maybe $50 a year or $75 a year or something like that. And again, unfortunately, sometimes individuals think that that's all that they're paying in fees and expenses because that's what they see disclosed on their statement. But when you have money invested in various types of investment accounts, there's both what's referred to as stated costs and then unstated costs. And so a stated cost would be exactly what you see on your statement. So that's an account fee or annual fee, or maybe some sort of commission or front end load or something like that for buying the positions. You then have unstated costs, and that's going to be things potentially like the management fees, the 12B1 fees, and other expenses that are not necessarily disclosed to you on your statement. Now, they may be disclosed in your prospectus, and so in order for you to find the true cost, you have to basically read through the prospectus and find both the stated and unstated fees and expenses. But most people don't do that, and they're kind of counting on the fact that most people are not going to do that. So again, we've got an example of how we can help you find what the fees and expenses are that you're paying that I'll share with you in just a moment. But then taxes will be another unstated cost that you end up having to pay, in particular on after-tax accounts or non-qualified accounts, in particular when they are invested in mutual funds. And again, if you followed us here in the webinar series, you've seen us talk in the past about how mutual funds can be incredibly inefficient in regular taxable accounts because they're subject to what's called triple taxation. You pay 3 different types of tax on a mutual fund and a regular taxable account. So that would be another unstated cost that you're not going to see on your statement. And so if you've missed that webinar, again, you can go to our website, and we have all of our previous webinars that we've done in this particular series. And we've talked about that a couple of times in the past. So I asked the question of everybody to let us know what you think that you may be paying in fees and expenses on your portfolio or on your accounts. And pretty typically what we will see, and that's kind of what I'm seeing here today, is most people will kind of guess that they are paying about 1% per year. That's the most common response that we get. And sometimes that's the case, but unfortunately, in other cases, the fees and expenses are much greater than that. So let me walk you through an example of how we can find that, because one of the things that we do at our firm for almost everybody that we meet with is we run what we refer to as a strategic wealth report, which will show individuals exactly what they're paying in fees and expenses each and every year. And what we do is we put in a percentage amount and we put it into a dollar amount, and then we give it to you to take home and to keep. So what I've got here on the screen is an example of a real world strategic wealth report that we put together for a couple that came in to see us recently that was getting close to retirement. Now, obviously, you can tell we changed the name of the individuals to protect their identity, but we left the brokerage firm that they were with on the report because this is pretty common of what we see at places like Edward Jones or Merrill Lynch or UBS, places of that nature. There's a lot of numbers and percentages here on the screen. What I'm going to hone in and focus on are kind of the most important numbers for you. And so you don't necessarily have to try and remember everything. Just kind of pay attention to the high level commentary that I'm giving you here. So this is a typical scenario where individuals had an advisor that was managing their portfolio for them, and they were paying an advisory fee, or sometimes referred to as a wrap fee. So when we sat down and talked with them, we asked them, hey, what do you think you're paying in fees and expenses? And they said, oh, we know what we're paying. We're paying 1.2%. And they said, we have about $1 million in the portfolio. So it's about $12,000 a year, or about $1,000 per month. And so what we said that we wanted to do when we saw that they had the money invested in mutual funds is we said, well, hey, let us just double check that and let us run a fee analysis for you. So what we did is we put together the strategic wealth report, and bottom line, what we found was when we added all the different fees and expenses together, they were not just paying 1.2%, they were actually paying total cost as a percentage just over 3% per year. And I'm going to go back and explain how we get to that number here in just a moment. But 3% per year, of course, on $1 million portfolio is just about $30,000 a year in fees and expenses. And obviously, they were shocked to see that they were paying that amount. And we see this scenario all the time, so we weren't that shocked. It's unfortunate. It's disappointing. But we see this play out all too often when we run these reports. And not to kind of pour salt into an open wound, but the bigger problem is the fact that individuals, when you're paying this level of fees and expenses, you have to pay it each and every year. Some may argue that if this was a one-time fee, maybe it would be justifiable. I do not subscribe to that. I'm just saying that some people would make that argument. Even if it was a one-time fee, I think it's too high. But that's usually never how it works. What we're talking about here is an ongoing fee every single year. So of course, over a 10-year time period, 3% in fees on a $1 million account over 10 years means that you lose several $100,000 in fees and expenses, right? Because that's about $300,000 over the 10-year period, assuming no growth. And when you add in growth and lost opportunity costs, things of that nature, it makes the scenario even a little bit worse. So we wish that we could share with you that this was an extreme example, but it's not. We see the scenario really all too often, if not every single day. When we're meeting and talking with individuals at least several times per week, we will find individuals and couples that are paying just as much in fees, if not more, than this particular example. So let me, to not distract you, let me take my picture off the screen here a little bit, and let me walk you through how we arrive at these numbers. And what I want you to do is go to the report, and let's go to the second line down. So what we do is we take all the different mutual funds in the portfolio, and we list their name. And let's look at the second one from the top. So that's the American Funds Bond Fund of America. You can see the percentage that's in the account right now, or percentage of the portfolio, is about 12%. The dollar amount as of their statement is right at $124,000, almost $125,000 that's in this mutual fund. So what we do through the report is we start to pull out the fees and expenses. So the first expense is going to be the management expense. So that's what you're paying the mutual fund to do to the day-to-day management. So the fund manager is inside of this mutual fund. He or she is in buying and selling different stocks or bonds, depending on the fund. And they're doing that trying to increase the performance or protect you on the downside. And in order for them to do that, they charge a fee. And on this particular fund, it's 0.6%. Now, as you can tell, some funds are higher and some funds are lower. And then what we do here at the bottom is we kind of average it out. So the management expense on this particular portfolio for the mutual funds is 0.84%. And again, sometimes people think that that's kind of the whole story, but unfortunately it's not. The next number that we always take a look at is the percentage turnover. Let me explain that briefly, because not everybody is familiar with what the percentage turnover means and what that is. But it's very, very important that if you have any money invested, that you find out what this percentage is, because the higher the percentage turnover on the portfolio or on the mutual fund, the higher your fees and expenses are going to be. Okay, so again, if we take a look at the second one from the top, the Bond Fund of America, that's showing a turnover percentage of 121%. Now, what this means is that over the last 12 months, 121% of the assets in the fund were sold and new things were bought. Now, the way that you can get over 100% turnover is they are buying and selling positions, but not holding them the full 12 months. Okay, so what that means is that there is a lot of trading going on within that particular fund. And the reason why I'm picking on this one instead of the very first fund is because I really want to drive home the point here today that you have to be extremely careful of having money, especially large sums of money, invested in bond mutual funds right now, because with everything that's happening in the economy and in the bond markets, we're seeing the portfolio percentages spike right now and go very high. And again, like I said, the higher the turnover percentage, the higher your overall fees are, because there's a cost for that turnover. So what that means is anytime that a mutual fund buys or sells a stock or a bond, that's not free. That's usually right at about 1%. Okay, so I know this is getting a little bit technical, but the way that it works is take the turnover percentage on the Bond Fund of America, that's 121%, multiply that by 1%. Okay, so obviously that would be 1.21%, and that's the cost of the turnover. So you take the 1.21% plus the 0.6% management expense, plus the wrap fee or the advisory fee being paid to the advisor, and that's where you get your total cost of 3% per year for that particular fund, or said another way, that's about $3,700 every year for them to manage that fund, assuming no growth. So again, we do that on every mutual fund that's in the portfolio, and then we kind of average and total everything at the bottom. So again, about $1 million in the portfolio, management expense averages 0.84%, turnover percentage is 111%. Again, I'm going to come back to that in just a second. You multiply that by 1% trading cost plus the advisor's wrap fee. This gives us our total cost of 3% per year, over $30,000 a year if there's never any growth within the portfolio. So obviously, as the value of the portfolio goes higher, the dollar amount that individuals are paying would go higher. If it goes lower, the dollar amount that individuals would be paying in fees would go lower. However, the percentage basically stays the same. Now, going back to the turnover percentage, again, this particular couple, before they started working with us, had additional bond positions. So you can see the Lord Abbott bond position, the SEI core fixed income, that's a bond position, and then the emerging markets debt, that's another bond position. As you can see, the turnover percentages are very high in all of those positions. And we're seeing that pretty much with any type of bond mutual fund out in the marketplace today. So when we're seeing individuals with a lot of money invested in bond funds, that kind of is a signal to us that really nobody's really minding the store. The advisor should really be watching out for this. Now, in this particular example with this couple who was working with Edward Jones, they were paying the advisor 1.2% per year to manage their portfolio. He turned around and just invested the money in different mutual funds and then kind of set an asset allocation, kind of set it and forget it. And he didn't pay any attention to it. So he hasn't reacted and responded as the bond markets have gotten very volatile. And there's other issues and concerns with interest rates with having money invested in bond funds that we've talked about in the past. So just one of the absolute, in my opinion, worst assets that individuals can be holding in their portfolio right now would be a bond fund, because the interest rate concerns as well as the turnover percentages being extraordinarily high. We've seen some funds that have turnover percentages going into the 6, 7, 800% range, which of course is 6, 7, or 8% in fees on top of all the other fees that they're paying. So one of the assets that you definitely want to avoid. Now, as I'm going through this particular presentation, anybody that would like a strategic wealth report, you can request one, and we are happy to provide one to you complimentary. What we'll need to do is have you to schedule a time to talk with one of our advisors on the phone. If you prefer to come into the office, we can work that out as well. We are an essential business. So if you'd like to talk with someone face-to-face, that's fine. We can do that. Or we can do a Zoom meeting or just a conference call with you. But anybody that would like to get one of these types of reports on their portfolio, we can provide that to you. And it is something that we recommend getting if you haven't seen exactly what your fees and expenses are recently, because in most cases, individuals are paying costs that are much higher than they ever imagined. And in an example just like this one, the fees are higher than what they were told by their advisor. So a lot of times if you ask your advisor, hey, what am I paying in fees? He or she may know what you're paying them in fees. But again, if they're investing the money in different mutual funds or other types of positions that have ongoing costs, you need to account for those fees as well. So again, anybody that would like one, just let us know and we're happy to provide one to you. I have another example of strategic wealth report that I'm going to share with you very fast on another type of asset category that we are not big fans of, in particular right now. As volatile as the market has gotten, you definitely want to make sure that you avoid having money, in our opinion, invest it in variable annuities, because here the fees and expenses are absolutely outrageous. And what ends up happening is as the markets have gone volatile, what's happening is as the market goes down, you lose more because of their heavy fees. Then as the market rallies and recovers, when it goes back up, you don't grow as quickly because of fees. So a high fee structure on your portfolio can kind of act like an anchor over time. One of the things that individuals will sometimes say to us is they'll say, you know, I've got this account. The market seems like over the last few weeks it's been recovering somewhat, but I'm not recovering that fast. I don't understand why. If that's occurring to you right now, that may be an indication that your fee structure is too high. That's usually one of the times when a high fee structure will kind of expose itself, because what ends up happening is when the markets are going up, even if you're paying a lot in fees, you know, every time you get your account statement, you're seeing that it's growing. So it doesn't feel like it's that big of a deal. But where it becomes a much bigger deal than usual is when markets are volatile, like what we're going through right now. So you definitely want to get your arms around exactly what your fees and expenses are that you're paying each and every year, in particular if you have money invested in mutual funds and or inside of a variable annuity. So here again, as we're walking through this, this is a real world example of a couple that came to see us. They were unhappy with the performance on a couple of different variable annuities that they owned. We had to put these types of investments on a different fee report because they have some additional expenses over and above what a mutual fund portfolio will have. So this particular couple had about $840,000 in the variable annuities when they came in to see us. They were being charged a mortality and expense fee of 1.15% on average between the two different variable annuities. Mortality and expense fee is just a code word for life insurance. So if you have money invested in a variable annuity right now, you're paying for life insurance, and again, you pay for it each and every year. Management expenses weren't too bad, only a flat $35, but they also had administrative expenses that averaged 0.15%, trading costs like we just talked about of 1%. They had a distribution fee of 1%, which is a code word for commission. So that's what was going to the advisor. So about $8,400 per year is what the advisor was earning on these particular accounts. There was a rider fee, which averaged just over 2%. So the variable annuities had some death benefit enhancements as well as some income enhancements that the individuals were paying a pretty hefty fee for. So when we added everything together on the variable annuities, they were paying almost 5.4% per year. Obviously, as a dollar amount, that comes out to be about $45,000 per year. And again, that's not a one-time fee. That unfortunately is an annual fee. So over a 10-year time period, that would be $450,000 on a $800,000+ investment. That's one of the biggest ripoffs, in our opinion, that we see in the financial services industry. The good news, as you can see on the report, the surrender charge or the back-end cost to get out of these variable annuities was 0%. So they had owned them for a few years, unfortunately. But the good news was they were able to make a change with them and get away from paying excessive fees and expenses, because basically they had to earn over 5% per year just to break even. And again, even though the advisor was only earning 1%, the true cost when we added everything together was up over 5%. And so when we run these reports on variable annuities, again, this is pretty common where we'll see individuals paying at least 3%. That's probably the lowest that we typically see. Usually it's more in the 4, 5, sometimes 6% range. I've seen them go as high as 8% per year in fees and expenses. Fortunately, that's rare, but I've seen it. So sometimes when annuities get a bad reputation, and you hear and read things like, variable annuities have, or annuities period, have hidden fees and expenses, and they're very costly. That's not true with all annuities. It's true with variable annuities, but that's usually what individuals are talking about when they're saying, hey, you don't want an annuity, they're too expensive. Usually when they're saying that, it's because they probably have had an experience with variable annuities. So again, if you have money invested in variable annuities, you would like one of these reports. Again, we're offering to run them complimentary. So you do not have to pay anything for these. It doesn't cost us very much money to put them together. So individuals in particular now more than ever need to have this type of information. So these are things that we're offering to provide to you or anybody that you know, friends or family members that you think may benefit from these types of reports. Send this information along to them or our information along to them. And we're happy to provide it complimentary to them because individuals just need to know this information more now than ever because of how volatile the markets have become. In order to fully recover from everything that we've gone through, you're going to need to maximize the return potential within your portfolios while minimizing the level of risk you're willing to take. And one way that you can do that is by making sure that the overall fee structure is as low as humanly possible. And of course, the only way of being able to do that or know that is to get the analysis done first so we can see exactly what it is that you are paying currently in fees and expenses. Because bottom line, what ends up happening is everything kind of falls into a couple of different choices that we have to make when we look at different investments that we're looking to put our money into. Because I always talk about if we want a higher rate of return than what the banks are willing to just give us, right? Because we could just leave our money in a money market account and earn little to no interest right now on it. But if we want a higher return than that, there's a couple of choices that we have to make. We either have to make the determination that we're going to put our money at risk or we're going to keep it safe. So I usually talk about there's no real in between on an investment. Your money's either going to be completely safe or it's going to have some risk element. So you have to be okay if you want a higher return on your money, either going with risk or choosing to go with some sort of a time element. So that's the other decision that you have to make when looking at an investment program. You either have to agree to time or fees. Now, what we mean by time is going to mean some sort of a time commitment, meaning I'll get a higher return on the money, but I'm not going to have full access to it for some period of time. So what we're talking about here is, of course, like a CD. If you agree to some time there, you can get better interest than you would get on a savings account. Again, maybe bonds in the right environment. If you invest in the bond and you agree not to ask for your money back for a certain period of time, you can get a higher rate of return. Certain annuities work this way as well. If you are going to have some sort of a time element with your investment or a time commitment, you want to make sure that you do not also have a fee commitment. It should be, in my opinion, one or the other. You don't want to have both within the portfolio. So if you're looking for a higher return than what the bank will just give you on your money in a savings account or a money market or something like that, you have to decide, am I comfortable putting the money at risk as opposed to having it completely safe? And if I do want to take a little bit of risk to get a higher return, do I want to agree to time or do I want to agree to fees? If you're not comfortable with time or fees, and if you're not comfortable with any risk at all, then you have to just leave your money on deposit in the bank and be okay with the low interest rates that they're going to be paying you. So again, it's just a decision that you have to make. One of the things we're going to do is next week, we're going to cover in the webinar different safe alternatives or safe money options that you can invest in over and above a money market or a savings account as far as the return potentials that are available to you. We'll cover that during the webinar next week. So again, before we wrap up here today, I have the 10 tips or kind of top observations from the last week or so from listening to different economic advisors and true experts within our industry and in and outside of the country. But again, if you would like the fee analysis that we've talked about, then feel free to schedule a time to talk with one of our advisors. To gather some information from you, and then we're happy to provide that to you complimentary. Okay, so here's the top 10 observations from economists that we've seen over the last week or so. So basically everything is from the perspective of what's going to happen moving forward. these are crazy times. We've already been through some things that are pretty crazy, but kind of what happens next. So number one, observations are companies moving forward are going to be less risky and less productive than what they have been in the past as a result of going through the crisis that we're experiencing right now. Number two, consumers are going to have more of a home bias. So even though certain states are trying to open up and over the months to come, hopefully everybody will get opened up, not everybody's going to be comfortable leaving for some period of time. So there's going to be a lot less travel. People will venture out of their homes at a lot lower rate. And that's going to go on for an extended period of time. Some think until there's a vaccine, and then others think maybe it will extend beyond that time period. There's going to be a lot more government control and involvement in everything. So even as we begin to reopen, you've seen different so-called bailouts or loans given to different companies, and governments are restricting and controlling our movement, what we can and can't do. So our activities are going to be very much different and controlled by the government, much more than what we've ever seen in the past. Again, more government control within the companies, and government's kind of picking winners and losers. There's so-called essential businesses and non-essential businesses. Some of the non-essential businesses have already closed. We're going to see additional ones do that in the future, and even some essential businesses that have been able to remain open, they're struggling to remain profitable and viable. So more bailouts to come as well, because I don't think that government intervention into the economy, either for consumers or businesses, I don't think that we've seen all of it yet. Maybe most of it is behind us, but I think that there are more bailouts to come. Number five, observation: consumers are going to be scared and less frivolous with their spending because they're all a bit shocked from what we've gone through, and they're not going to forget about it anytime soon. So individuals won't be looking to spend as much money as they have in the past. They're going to kind of start to hoard cash more and just kind of set it in reserves. All of this will cause, number six is all of this will cause both supply and demand issues on a very large scale. Some of the companies just aren't going to be there to produce certain items that we're trying to buy, and then demand for other items just aren't going to be needed. So supply chain disruption is something we're going to have to deal with. Number seven, all of us are going to have a heavier debt load. Individuals, companies, and the government. We all are kind of taking on additional debt at levels we've really never seen before. So that brings us to number eight. Government, consumers, and companies moving forward will be kind of focused on trying to pay off or eliminate the debt that they've accumulated. So again, there'll be less innovation, less spending, and that will cause the true recovery for the economy to kind of drag out. And it's going to take us a very long time to recover is the real consensus. Which brings us to number nine, that most people's opinions are right now that the stock market is very high, all things considered. And there's a bit of a false hope that we're going to have a real quick recovery, which most economists don't really see happening. We hope that it happens, but the reality is the damage is kind of done. I talked about it during the webinar last week, that for pretty much every day that the economy is in this kind of shutdown mode, it's going to take maybe 3 to 4 to 5 days to recover. So if we're closed down for a month, maybe we're looking as many as 5 months to kind of recover. If we're closed down for 2 months, it could be as many as 10 months to recover. That's not going to be a rapid recovery. And there's some that make the argument that it'll take years to recover. So of course, time will tell, but the projections are that the stock market just has a lot of false hope built into it right now. So again, maybe an opportunity to lock in some of your winnings that you've seen during this recovery over the last several weeks. We're not at our all-time highs that we saw in February, but we are a lot higher than what we were at the bottom of the bear market so far. And there's a lot of individuals that think that we could possibly test those lows again. So maybe a good time to make a bit of an adjustment on your portfolio. It's certainly not too late. And then the last observation, number 10, is we will certainly eventually emerge from all of this, but it's going to be a very slow growth and dangerous environment, not knowing exactly who's going to succeed and who's going to fail moving forward. So those are kind of the top 10 observations that we've seen since the last time that we were together. Of course, each week we will continue to bring you additional news and notes as we learn interesting information we believe that we need to share. Don't forget, again, kind of last opportunity, if you would like the free strategic wealth reports that we talked about to get the free fee analysis, then click on the link and we're happy to schedule a time that we can provide that for you. And if you haven't done so yet, please give us a follow on our Facebook page. We're doing some economic updates there. You'll be able to see what the upcoming webinar topic's going to be, as well as we're doing some fun things like we've done trivia night recently. We have a weekly cooking show and just trying to mix in some educational information as well as maybe some fun things that we can do while we are all dealing with this unique environment that we're in right now. So if I did not answer any questions that you may have had, continue to submit those to us. We will have someone reach out to you and get an answer to the question. And I look forward to seeing everybody at some point in the future. Thank you once again for tuning into Strategic Wealth Live, and you have a great week. Thank you.